This model is not just trying to tell me whether a stock is cheap or expensive. It is trying to tell me what the current stock price is already assuming, because the stock price is not just a number. A stock price is basically the market's expectation packed into one number. So instead of me saying I like this company because it is a good business, I should ask question like, at today's price, how good does this company need to be for the valuation to make sense? So this is the key. So if you look at normal DCF, it's like I forecast the company's future sales, margin, cash flow, WACC, and terminal value. Then I calculate the stock value. But this model does the opposite. This is more like the reverse DCF. I start with today's stock price, then I work backward to find out what growth, margin, cash flow, and forecast period the market is already pricing in. So it changes the question from what is my fair value to what future performance is already embedded in that stock price. So that is a much better question to ask. One important thing is in that chapter, the author is not just randomly making up those assumptions by himself. He actually used street sources like Value Line, Morningstar, the Wall Street analyst estimates, and other market data sources to get assumptions for sales growth, operating margin, tax rate, WACC, and reinvestment needs. Then he put those assumptions into the model and reverse engineer what the current price is pricing. So the model is not a randomly pick numbers and get a valuation. It is more like I take this assumption that the market or analysts are already using. Then I use the model to understand what the stock price already expect. So this is why this model is useful. So for example, if a company is trading at a very high valuation, the market may already be pricing in strong sales growth, margin expansion, and many years of value creation. So even if the company is good, the stock may still be dangerous. Why? Because the market already expects too much. That is why sometimes a company reports good earnings, but the stock still drops. The numbers were good, but not good enough compared with the stock price already expected. So this model helps me avoid buying a good company at a stupid price. The way I think about earning is stock price reaction is not just about whether the report is good or bad. It is about report versus market expectation. If expectations are low and the company reports better than expected numbers, the stock has a better chance to go up. Even if the report is not amazing, as long as it is better than feared, the stock can still react positively. But if expectations are already high, even the good reports may not be enough. The company may report solid growth, but if the stock already priced in perfect execution, the stock can still drop. So the real question is not, was the report good? The real question is, was the report better or worse than what the market already expected? So this is the game. This is also connects to the implied forecast period. If company reports strong numbers and the stock price does not move much, then the required forecast period may become shorter because the fundamental improved, but the valuation did not fully reprice. That means the stock may become more attractive, but if the company reports strong numbers and stock price jumps a lot, then the implied forecast period may stay the same or even become longer because the market is now pricing in even higher future expectation. So a good report does not automatically mean the stock is still cheap after the move. The question I need to ask actually is, did the fundamentals improve more than the stock price moved? that is the real analyst mindset, or real trader mindset, fundamental trader mindset. For implied duration, um, shorter is usually better for a buyer because it means market has low expectation backed in. The company does not need to be perfect to justify the current price. Longer implied duration means the stock is more demanding. The market expects the company to keep creating value for many years. But long duration is not automatically bad. Some high quality companies deserve a long duration because their competitive advantages is real. So I should not just say short duration is good, long durations is bad. The better way to say it is, I care whether the implied duration is reasonable compared with the company's actual competitive advantage period. So for a long idea, I want this setup is the market is pricing short implied duration, but my research says the company can create value for longer. That means the market may be underestimating the durability of the business. For the short idea, I want the opposite side. The market is pricing the long implied duration, but my research says the company cannot deliver that. Maybe growth is slowing and margins are under pressure, competition is increasing, or the return on investing capital is weakening. The ROIC is weakening. That means the stock is priced for perfection, but the fundamentals do not support it. For long idea, I want to find a situation where the market expectation is too low. For example, the market is pricing in a low growth, flat margin, and only the few years of value creation. But after doing my own research, I believe company can grow faster, improve margin, and keep generating strong returns for longer. Then that could be a long opportunity. So my thesis would be like the stock is priced for weak expectations, but I believe the business can perform better than what the market is pricing in. And that is the real investment thesis. For the short idea, it is the opposite. I want to find a stock where expectations are too high. For example, the market is pricing strong growth, margin expansion, and perfect execution for many years. But I see growth slowing, competition increasing in the industry, margins are under pressure, and the guidance given by the management, the guidance getting weaker. Then the short thesis is the stock requires perfect execution, but the fundamentals are already starting to deteriorate. So that is a clean short setup. So for me, this model is not just the valuation tool, it is an expectation tool. It helps me understand what the market already believes, then I compare that with my own research. The opportunity is not simply this is a good company. The real opportunity is the market expectation is wrong, and I have a better view, and that is where the alpha comes from.